If you guys have been trading for years and feel like you're stuck, the reasons for that have very likely never been made clear to you, but you are in exactly the right place to understand why so many traders stay stuck. And yeah, let's get straight into this video. So I know how it goes, guys. I've been here myself. All traders go through this. You've poured hundreds of hours into the screens, and you've basically sacrificed your peace of mind to get where you are and to master this game. You have the knowledge, you have the work ethic, but after years of impressive effort, you're still standing at the same spot, monetarily speaking. You've been at the standstill for a while, and it becomes very emotionally taxing. It becomes hard to bear. You've been doing this for so long, and the emotional weight that this has on you really starts to grow. And you keep moving forward because you've signed this contract with yourself, which says that I have to be profitable. At the beginning, you said to yourself, I'm never going to give up on this, and this is why you're here now. You've been here for years, and there's nothing that can stop you from becoming profitable. And so you're still here despite all this emotional fatigue. And so you isolate your flaws, you make your adjustments, and you commit to improvement. But still, something unseen, some sort of friction that you can't quite pinpoint, keeps resisting you from the profitability that you want and that prosperity. Each improvement that you make throughout time feels like a very logical step forward. Every tweak reinforces the belief that you are refining your system and that you're closing in on that breakthrough, on that progress and the prosperity that you've been trying to get to for so long. But things don't change, and there's nothing that really manifests itself. The problems that we solve and the solutions and the tweaks that we make to our system never truly manifest and represent itself through change within our P&L and within our trading outcomes. The life that you want feels closer in your head because you're making all this improvement, but it has not yet entered your reality. And so, you tell yourself, and we all love to do this, that we're almost there, and that the tweak that we made last night as we were reviewing our journal is what we need to become profitable. And the reason that we do this is not because we just want to feed our ego, but it's because we genuinely think that it's what we need to be profitable, and that the improvements that we made are going to repair the system and get the gears turning and moving us into the profitability that we want to see. But your P&L has not and still does not recognize that version of you. And so you continue to invest your most valuable asset, which is your time, into a system that has not and is not paying you back. And the weeks turn into months, the months turn into years, and the weight of this and the emotional tax only gets heavier. And so underneath the hustle, underneath all the reviewing, all the grinding, is this growing and very quiet fear, which is that you're trading your most valuable years for a horizon that you may never reach. And I'll tell you what, you can get that shit out of your head right now, because you can do this. Other people do this. I do this. And I'm going to teach you guys how to do it. But the truth is that this is not a character flaw, right? It's not your discipline. It's not your ego. It's not your emotions. I think you already know that by now. The problem, which you probably don't understand in ways that we're going to get into, is that you have a fragmented system, and it's fundamentally broken in ways that have never been made clear to you. And so this is most trader systems over here. It's fragmented, it's incomplete and broken, and the reason for that is because it does not adapt to the changing market conditions, and it does not clearly define how decisions should be filtered. And so that lack of structure is naturally going to lead to low quality positions, degrading the trade quality, increasing the chances of taking losses, which is going to decrease the chances of making money consistently. So it's kind of this chain reaction that starts from the base, which is the system itself, the foundation of the system. So how are you to properly evaluate a system when the system itself is incomplete, right? If the input is flawed, how could the output not be flawed? And so without a proper understanding, that system quality is going to become nearly impossible to properly evaluate, preventing true growth and perpetuating a cycle of poor trade selection and misattributed errors. And so the key point here is that it's going to be nearly impossible to properly evaluate. And so what I'm speaking about here is that there's sort of this glass ceiling when your trading system is incomplete, right? And so you can make the effort, you can make changes within your system, and you can improve. However, if the system itself is flawed from the base and from the foundation, there's going to be this glass ceiling that you cannot break above, and you can't properly evaluate the system such that you actually break above that glass ceiling and transcend into profitability. And so the truth is that the reason that the progress feels real, but the results don't change, is because of this incomplete system. and you can refine your execution endlessly, but without a complete map, the profitability will remain a desire and not an outcome. So now we're going to be taking a deeper look into this. We're going to be looking into statistics, facts, and quotes from the most reputable institutions to ensure that you guys have a sufficient understanding of why most traders are left behind. And be sure to stick around to the end. Everything is going to come together through a framework designed to ensure that the effort that you've been putting in can finally get you above that glass ceiling, and you can hop off the treadmill and start running forward into the profitability that you deserve. This framework transforms the scattered and all the incomplete, misaligned information into a single and complete decision process that you can trust. So, first things first, what is the CFA Institute? So, the CFA Institute is an institution that is responsible for setting ethical and professional standards in the finance industry, and they have a ton of different articles. And what I found when I was looking at this one is that they describe markets as dynamic, evolving, and highly interconnected. So what this means essentially, dynamism, what that means is that price is not driven by one single factor. Rather, it's being driven by multiple different variables, and the way that they're interacting with one another and the way that they're operating simultaneously is actually creating price. And that is the reason of why price is moving. So a lot of traders will look at price as if it's this standalone signal, and they don't account for the underlying variables driving it, simply because, well, mostly because a lot of traders don't understand what those variables are and how to use them. And so this is automatically going to be a recipe for low quality positions. And the analogy I like to give is this is like a mechanic trying to fix a car without understanding the engine. How could you possibly fix the car if you don't understand the base, the foundation, and if you're not using and not aware of the variables that are driving price? It just doesn't make sense. And so essentially, changes in one area of the system can have nonlinear dramatic effects in other areas of the system or change the behavior of the system as a whole. So again, that has a very important implication, and it's absolutely essential that we understand what these variables are that are driving price. So this slide is very closely tied together with what we were just talking about, and what it states is that reproducibility, aka consistency, is greatly hindered if there is a lack of access to raw data and scientific methodologies. And you might be like, no shit, no kidding. But what this is really doing is it's reinforcing two things. One is the understanding that inconsistency is not flawed by a lack of intelligence or effort. And secondly, it raises a very important claim, which is that when a system does not address the variables affecting price, which is what we just learned about in the previous slide, then the odds of reproducing consistent profits will consequently decrease. You know, this is just logic. This is just, it makes sense. If you have a flawed input, you have to have a flawed output. So you can't possibly reproduce consistent outcomes if you don't understand variables driving price. Well, consistent profits, if you don't understand variables driving price. So a lot of traders operate under the false impression that more trading equals more money, right? If I'm more active, if I'm pursuing more opportunity, and if I'm trading more, then I'm going to make more money. And in the beginning, I think all of us had this impression, because think about life outside the markets. If you go to the gym and you put in more reps than you did last time, and assuming you eat the same, then you're going to gain more muscle. If you go to work and you put in more hours, you're going to make more money. If you go and ask out more girls, there's a higher chance that you'll get more numbers. And this sort of conditioning in life outside the markets bleeds into the markets, and it makes us think that effort and reward have some sort of reciprocated or are on the same level. And that's not true. And we can look at this paper and this research done by these two gentlemen from MIT and SMU, who went in with the thesis question of what is the optimal trading frequency in financial markets. And what they find is a completely inverse correlation between trade frequency and profit potential. They look at 4 liquid contracts in the US futures market, one of them being the E-mini S&P 500 futures, and their sample period was from January 2013 to August 2016. So that's about 3.5 years of data. That's going to increase the validity, the trustworthiness, and the credibility of their claims, since they have more data, more claims, more trades. And so what you guys are seeing right here is a direct copy of this right here. I pulled this directly from the article, and It's a bit confusing, so I simplified it to make it more comprehensible and understandable for us. And so what these guys find is that more frequent trading is obviously going to equal more chances to trade. But when we account for actual new information arriving into the market, the good thing about having more chances to trade is completely wiped out and made worse by the fact that traders submit weaker, more timid orders in each individual auction because they know that another chance is going to come soon. Therefore, slowing down trading actually makes things better. So what they find is that, contrary to popular belief, effort and reward have an inverse correlation. And this is imperative for us to understand. Most traders don't understand this, and they just get burned. And it keeps traders from high quality setups and from making consistent profits. It's one of the reasons, on top of what we've talked about so far. So one of the key themes in this video so far has been that most traders just flat out do not understand the variables that are driving price. But we're going to peel this layer back a bit and show you guys an example of what it is that I'm talking about so that you can just understand it better if you are a bit confused as to what I mean. And also, it'll allow you to understand really how integral this is to understand. So within the S&P 500, there are about 70 to 75 companies that are either classified under the information technology sector or are primarily tech-driven. So, whether they represent the IT sector or are primarily tech-driven, we can combine these to come up with the tech core, what I call it. And this small group, although it accounts for about 15% of the S&P 500 numerically, when we look at it from a market cap perspective, which is, astronomically more important, we understand that 40 to 45% of the S&P 500 is being driven by the tech core. And so this is absolutely imperative that we're watching these tech names to have a better understanding of, if we understand what tech is doing, then we can have a better understanding of what we should be doing in the S&P 500. It's as simple as that. And there is an instrument that we can use, like one single instrument that we can condense to be watching these tech and tech-driven companies. If you guys watch my channel, you'll find more out about that, but hopefully this example allows you to understand really just how integral this is. If you're taking trades that are not aligned with the market context, and let's say you want to be along the S&P 500, when tech is weak and tech is not exhibiting strength, well then it's not to say that that trade is not going to work out, but fundamentally and by default, with tech being weak, the odds of that trade, the trade quality of that trade is going to be lower. And so when you define context first, you are automatically going to be filtering out misaligned trades. You will stop chasing price and you will stop second guessing. So the reason for this is because we use context as a core pillar and as some sort of filtration system to be understanding if we should be in the market or if we should not. So by default, we're going to be filtering out misaligned trades. If context says that we should be in the market, well then that is going to act as one of the reasons that we can actually be in the market. It's not the only reason, right? Like, we can't just use context to justify an entry in the market, but it is acting as a very important piece for us to understand to be participants in the market. And so we can filter out misaligned trades and low quality setups by using context. And we stop chasing price. So we have more conviction in sitting on our hands and being patient, and there's more comfortability in not being a participant in the market, since we understand that context is not supporting the trade. If context is not supporting the trade, I am not in the market and I am comfortable with that. That's what happens when you start to use context and you stop second guessing. So when you get in the market, you're going to have more confidence in your entries, because again, if context is telling you to be in, then you be in. And of course there's other variables that are affecting that decision, but it'll just overall increase your confidence, and it's going to increase your market understanding, which is going to inadvertently increase your conviction in your own trading. So it's the foundation of what we do here at the volume method under the CLC model. CLC being context, location, confirmation. Context is the first thing that I'm always looking at to ensure that I'm taking high quality trades. So now moving away from the context side of things and looking into other reasons for why so many traders fail to reap consistent gains in the market, we're going to be looking at this from a locational perspective. So if you are unaware, not all price zones are created equal. Research on price sensitivity shows that demand, or in other words, participants, respond differently at specific thresholds compared to mid-range levels. So this is going to have a very important implication for us. What we understand is that participants make up the market through their volume and through the orders that they are imposing onto the market and how they add and and subtract liquidity from the market by being an active participant. And so if they respond differently to this level than that level, then of course this is going to give rise to some very important implications for us. So these people came up with a thesis question of when do price thresholds matter in retail categories. And I'm not going to read this off, but I did pull this from the text. It's a bit difficult to understand. In simple terms, what they find is that people don't react to every price change. Now, that goes without saying. They only respond to changes that move outside of a range that they consider meaningful. So, that's a little bit more important than what this is saying right here. What it means is that traders will either perceive the value of price to be fair, at which they can buy, or fair, at which there's less opportunity, or unfair, where they can capitalize on a move back down or a move up away from that unfair value back into fairness. And so what this means is that in practice, not all price levels are equal, because if the people and the engine that makes up the market, which is the people applying and distributing the volume, perceive the value of price to be different across price levels, then by default, not all price levels are going to be equal. And so since that's true, through logic, a locational filter becomes a prerequisite for high quality trading. Because if you have the understanding that not all price levels are equal, you understand that this price level right here is less desirable and has less of an edge than this price level over here. So we have to have some sort of locational filter so that we're not trading at the bad locations where there's less edge, and that we can be exploiting our opportunities at the high quality trading locations. So again, a locational filter is a prerequisite and a non-negotiable to high quality trading. So opportunity does not come from movement alone in the market. You don't just buy when price moves up and you don't buy when price moves down. I think we all know that by now, but you don't just buy when you're contextually aligned with the market. It depends on where that movement is occurring as well. We have to have this locational filter as well as the contextual filter to be aligning with the market from a high quality lens. And so we're not going to spend too much time on this slide, but it's this false paradigm that sucks so many traders into this really this process of thinking that they are making these monumental improvements within their trading, but in reality they are victim to some sort of execution trap, right? And what this is saying and what I'm talking about, the CFA Institute classifies trade execution, which is essentially like, where is your stop loss, where is your entry, what is your risk to reward, where's your target, did you remain emotionally composed during that trade, like how well did you execute the position. So they separate that from trade selection being like the reason that you actually got in. So why did you buy, why did you sell, what were the reasonings, what's the evidence that actually made you get in the market. So obviously those are two very distinct processes and they are relatable in some ways, but the CFA Institute differentiates them. And so what most traders will do is that they'll blame their execution when the results fall short. But the real issue is the trade selection. So again, they blame their execution. They say, oh, my entry was fine, I just got wicked out. My stop was too tight, I got unlucky with the timing. And I'm not sitting here and saying that sometimes that's not the issue, but for so many traders, the issue is the actual infection, which is a poor and fragmented and incomplete trading system. And so when you sit here and you blame the execution and you spend so much time reviewing the execution and you spend all this, journaling time coming up with the answer to your trading and coming to find that it's some sort of execution problem, that's a fallacy. That is a most likely incorrect evaluation of the true problem of people's trading, simply because they are blind to the real problem, which is improper trade selection. And so this is a false paradigm, and it traps a lot of people. But by being aware of it, can we understand when to potentially recognize it? And so this is something that holds so many traders back. Aha, the most critical question in trading. Should I even be taking this trade? So, I mean, most of us, I understand that most traders don't have any sort of robust framework to actually filter trades. They have no sort of detailed or analytical approach to differentiating low quality from quality. There is no filtration. So when they sit there and they get to the markets, they're not asking themselves if they should be taking this trade because their system isn't even optimized to ask that question. Like, there is no way that they could ask that question simply because their system is not addressing the variables that need to be addressed. They're not addressing the market contextually. They're not addressing it from a contextual perspective. And or excuse me, they're not addressing it from a contextual perspective, and they're not addressing it from a locational perspective, and they're not looking at these variables that are so important. And really the cherry on top variable that is important for us to be monitoring and ensuring that we instill within our trading is confirmation. And so the reason I say cherry on top is because it's usually the last thing that you do before you actually get in the market. And so what a lot of traders do is they use indicators to do that. And this is flawed. And this is another reason why so many traders fail. And I'm not saying that, indicators can't be used to make money, but what we can understand by looking at research per this source, CMC Markets, most technical indicators are lagging, and they lag, and lagging indicators tend to move behind the price, and it provides delayed feedback to the trader. And so this is an absolute detriment. When you use an indicator to confirm a trade, it's more than likely that it's going to be lagging, which is going to give you a skewed analysis of what's going on in the moment, which is going to lower your trade quality. So like, again, most people aren't even looking at the market contextually or locationally, like from these important perspectives, and they use indicators, and like, it's just a flawed analysis. And it's just another reason why so many traders fail. I think a lot of people do understand that indicators lag, but for those of you who don't understand that they lag, and most of them do. And it really offers as a pretty detrimental tool and confirmation tool that we use to validate an entry in the market. I mean, like, you're sitting there and you're saying that I should be long the market because price crossed some lagging line. Like, and again, I'm not trying to like talk down other people's systems, but like, it's true that it lags. So therefore, it's an inaccurate representation of what price is doing right now. And so at this point, you guys might be wondering, if indicators give me a delayed entry confirmation to get in the market, and if candlesticks are giving me a limited amount of information about the buying and selling that's going on in the market, then what tool exists to allow me to understand what's going on so that I can have a more accurate understanding of the buying and selling to allow me to make higher quality decisions? And that's a very good question. And the answer to that is order flow. So order flow is not only going to show us real-time market buying and selling, but it's going to allow us to see institutional activity. So it's not lagging, and it's real-time, showing us the buying and selling activity through synthesizing the buying and selling under these different tools. So this is a heat map. This is a delta footprint chart over here, and they are more or less showing us the same things. Not going to get too deep into that, but the point is that this shows us buying and selling in the market in real time, which can allow us to understand more of what's going on so that we can make better quality decisions. And it allows us to also see these institutional players, what they're doing. Institutional activity, so portfolio managers, hedge fund managers, prop firms, banks, etc., like these mass liquidity adders and distributors throughout the market. These guys make up about 60 to 70% of the liquidity within the S&P 500 on a daily basis. And therefore, since they make up the S&P 500 essentially in terms of liquidity, we want to be following them. And the only way that we can really follow them and understand what they're doing is through these order flow tools. So for these reasons, it's a very powerful tool that we can use to understand more about what's going on in the market and use to actually have a entry signal in real time. You guys have heard me give many analogies today, but fighting a ghost is really the most accurate one. You guys now understand at this point in the video why so many traders are left behind. It's because they're fighting a ghost. You know, they think that their problem might be rooted in some sort of execution flaw, and they don't know how to actually evaluate their system properly simply because they are unaware of what's going on. They're unaware of the problems that are plaguing and really just keeping them from the success that they want to see. And so what I call this, and what it can be referred to as, is the competence trap, in other words. And it occurs when a trader is proficient enough to extract occasional wins from a fragmented system, but not knowledgeable enough to recognize that the system itself is incomplete. These intermittent successes reinforce flawed assumptions, causing the trader to refine execution within a framework that cannot produce consistent results. And so really this is like the trap. This is what so many traders go through. It's like a maze or a ghost. They don't understand the variables that drive price, and they have these beliefs and attitudes about ways that they should be approaching markets, which, as we've learned through research, is actually flawed, and it would be better to approach it in different ways. And so to reiterate this more in depth, a lot of traders are ignoring market dynamism. So they treat the market like it's a static math problem rather than some living and breathing auction like it truly is, which is being driven by shifted variables. They will look at price as if it's just one thing, right? And they will learn an incomplete system. So they've been sold a collection, and this is not traders' faults, right? This is just the industry noise and the bullshit that plagues the space. They are sold surface level patterns that don't translate to the real-time auction. They wonder why price doesn't really respect their levels, not really understanding and not having the knowledge that they simply are trying to navigate an ocean with a frozen map, basically. And it's just basically very close to, I don't want to say impossible, but it really increases the difficulty of it by using this incomplete system. And traders will also operate under the impression that trading more is better, and they're really just mistaking more activity for progress. And they think that more trades is going to fix their P&L because they have more opportunity, but really they're just accelerating their own decay. So many traders treat all price levels as equal, and even if they do understand that not all price levels are equal, they don't know which levels hold more relevance and institutional weight and which are noise, and they don't know how to differentiate that. So that locational lack of understanding is going to increase the odds that they interact with the market at from a lower quality angle. And so many traders will obsess over their execution, victimized by their own selection. And this is the sort of false paradigm that we were talking about. They try to perfectly execute a trade, but that trade should have never even been taken. And so again, that's very difficult to pinpoint and to understand why we shouldn't even be taking it when we don't have sufficient knowledge. And a lot of traders will hide behind indicators. So they look for some sort of lagging line to give them permission to enter rather than understanding the true mechanics of why price is moving. And this is really what so many traders struggle with, even if they don't understand it. Here we can branch off from all of the problems, all of the pollution that plagues the industry and that keeps traders from success. We can move on from the ghost fighting and learn a system and talk about something that really offers the opposition to all of these flaws, which is my CLC method. It is entirely market mechanic based, and it will put you within the structural alignment within the market. So there's a dynamic auction protocol. So it's a systematic framework that is designed to identify and align the core variables that drive price. So every day before the market opens, contextually, we are analyzing the market to see how these variables are performing, to see really the status and the nature of the market and how we should be positioning ourselves. We have a complete framework that eliminates fragmentation. So the CLC method, if you are unaware, is an acronym for context, location, and confirmation. So it takes all the problems that all these traders are facing, that where they don't look at market context, they don't know how to locationally filter their trades, and they don't use confirmation tools that show true buying and selling in institutional activity, it will take all of those problems and it condenses it into a unified system that will eliminate all the fragmentation and all of the incomplete information. Also, it is quality over quantity by design. So this framework focuses on identifying high quality positions and trading less, opposed to maintaining a high trade frequency, because as I've learned, trading less will put you in a much better position to succeed. And so the system forces you to be taking high quality trades through context location confirmation, which means that you are going to be trading less, but again, that is a much better thing. We restrict our entries to high quality locations only. So we isolate the high interest zones that so many traders are unaware of. They don't know how to pinpoint these areas where there's edge in the market. Those are the areas that we trade at. And this is where the institutional volume and liquidity is concentrated so that we can be trading with the institutions and not against them. And what's also true is that we use real-time market synchronicity. So we are looking at order flow tools to capture the immediate shifts in supply and demand, or AKA in selling and buying as they happen. We're not using these delayed and incomplete tools to understand or to try to understand what's going on in the market. I have a philosophy of selective participation. We should be really trying to orient our trading and align it and associate it with high quality trades only. And so again, most traders don't know how to do that. They don't have the knowledge, but CLC is all about doing this. It's about applying a filter that will keep you out of low quality trades, and it only lets you participate when structure supports that trade. This is no bogus. I mean, before I get in the market every day, before the market even opens, I'm doing a contextual analysis. I'm doing a locational analysis. And when the market's open, I'm looking at real-time confirmation to validate an entry. And I'm not stagnant. I'm moving with the market because I understand that context moves and it shifts. And on top of this, price breaks through locations. It forms new locations. So the system itself is literally forcing you to change with the market, and it will filter out the low quality trades, and it will only let you participate when the structure supports that trade through context, through location, and through proper entry confirmation. And so, of course, I'm not sitting here and trying to preach to you guys that this is about avoiding every loss, okay? If anybody tries to do that, run for the hills, right? It's about ensuring that every trade follows a structured and repeatable decision process before any capital is at risk. This can allow us to take higher quality trades. So again, CLC, context location confirmation. Context is going to define the directional bias through the volatility index, which I'm not going to explain here, and clarify whether the conditions favor a sustained movement before any trades are evaluated. So before I'm getting in the market, I understand what direction I'm looking to trade, and if price is at my location and if I get confirmation at the time of entry, is the context supporting more so of like a sustained rally move or some sort of rotational or shorter end move where I should be looking for a smaller target? Context, the contextual analysis allows me to understand that and approach the market with clarity. Location, so we isolate the key supply and demand zones to ensure risk is taken at only structurally significant levels. We're not looking to trade in the middle of the overnight low, in the middle of the overnight chop zone, the middle of the previous day's range. We're looking to trade at extremes. We're looking to trade where there's true buying and selling in the market that actually has institutional buying and selling activity, which is really what moves the market. And by doing this, can we put ourselves in a better position to take higher quality trades from a locational lens? Confirmation requires real-time order flow, confirming before every entry, preventing premature execution. So you're not sitting there and jumping the gun on your entries. You are quietly and patiently waiting like a disciplined trader to let the order flow show you that you should be in the market. You don't have to guess. You don't have to look at a candlestick and say like, I think buying is coming in. Let me buy. Because that's all you can do with a candlestick. Like there is no buying and selling that you can see beneath the candlestick to actually validate an entry. And what's also true is that with indicators, you can't sit there and understand when the buyers are stepping in on a move that you're trying to long, other than like, sure, price could cross the line, but what does that really mean? It doesn't mean that buyers are actually stepping in to the degree that would validate an entry. It might mean that, but you can't know that if you're not using these tools. But by using these tools, can you actually understand when true buying is stepping in and when you should be in and when you should be out? Inside of the volume method, you're provided with the tools, the education, and the structure that is required to apply the CLC framework with consistency and conviction. I post pre-market plans every day, so I establish a daily directional bias, which is obviously subject to change throughout the session, and I'm marking key areas of interest, which is also subject to change throughout the session. But what this does is it allows us to approach the market with structure and with intention, ensuring that our decisions are calculated and not reactive. Live trading guidance. So I have a intraday commentary section where I'm updating the chat with my thoughts as to how the session is unfolding, what the new information means, how I'm adapting to it, and really where my head is at as time is proceeding throughout the intraday session. I keep real-time updates on shifting context, key levels, and confirmation criteria as conditions change, with also just a plethora of very useful key points of information that a lot of traders don't understand and overlook. Direct access to professional grade tools that are displaying real-time participation, volume distribution, and confirmation signals. And you also have 24 access to me, personalized feedbacks. You guys can send me anything to refine your decision-making process. I'm always here to help. And so I want to be very clear, this is not a signal service. The volume method is built for serious traders who are invested in their development. They are ready to understand how markets actually function and willing to follow a structured process. They're willing to put in the time and they're willing to put in the effort to learn how markets truly move so that they can truly become prosperous and successful. Sustainable performance does not come from strategy hopping. It comes from a systematic application of a sound framework, and that is exactly what we teach here. And so you have two choices. You can be like this guy who takes path one. You can keep trading a fragmented system that never fully explains why price moves. You can keep making decisions without a real filter, reacting instead of selecting, keep pushing forward only to collide with the same invisible ceiling, keep fighting with the ghost, and on the same treadmill that you've been running on this whole time. Or you can take path two. Path two is to join the volume method and to apply a decision framework that is designed for clarity. You can use a structured framework given directly to you to guide your decision making, filter out low quality opportunities before your risk is ever even taken, and adopt a system built around real market mechanics. One path is going to repeat the cycle of noise and the ghost. The other is going to build the architecture of an edge that is going to transcend and move you into the life that you have been working for. If you're serious about trading with clarity, you will gain access to these structured pre-market plans, the live trading, the order flow tools, this complete CLC framework. And again, this is not for shortcut seekers. This is for traders committed to learning a repeatable, decision-driven process. If you're ready to stop fighting ghosts and learn real market mechanics, then go ahead and click the link in the description below.